Chapter 8 is a discussion of accounts receivable, and it's also a discussion of notes receivable. This class really does build, so what we talked about in the past applies, and we're just continuing with that and discussing what happens really after we've made the sale. So we made some accounts receivable sales, and then we need to talk a little bit more about what can happen with them. The other topic of this chapter is notes receivable. And there are times when you would not want to put it on an account for a customer, but you would want to have the customer sign a formal document. So when we talk about notes receivable, we're talking about them signing a formal document. And with that, there will be interest, and we'll talk about interest calculations. So there's going to be a series of audio voiceovers in this Chapter 8. I believe there's 4 for this chapter, and the first one is really an introduction to uncollectible accounts and what uncollectible accounts are. So the first PowerPoint will be talking about uncollectible accounts and the accounting that goes along with that. And we have write-offs, and we also have estimation journal entries. And then another voiceover will talk about how we actually come up with the numbers. Then we'll talk about notes receivable and how interest is computed. Accounts receivable turnover is a similar number to inventory turnover, and you'll see the similarities there. And then we also have something called the direct write-off method. That's not really GAAP. It's not a generally accepted accounting principle, but there are certain times when we can use it. So this voiceover is just going to be discussing or introducing you to the concept of uncollectible accounts. They are accounts receivable, and they are accounts receivable where the customers are not going to pay us. Now, you might kind of think this is a little strange that it happens this way, but when a business has sales and they have sales on account, so a customer comes in and says, I want to put this on my account, a business just assumes that a certain percentage or a certain number of those sales will never be turned into cash. In other words, the customers will never pay us. And businesses accept this, and they consider this as a cost of doing business with credit. Now, if you didn't have credit sales, then you're going to lose sales because the customer is going to have the cash or not make the purchase. So businesses use credit to get the sales. They believe they need to do it, but on the other hand, they recognize that some of these customers are not going to pay. So it's back to the matching principle with uncollectible accounts. Whenever we have sales, we need to have an expense that's also put into the financial statement to estimate the amount that will not be paid from those credit sales. So on January 1st, we could have a credit sale, and we record it as a sales revenue and an accounts receivable debit. And this accounts receivable would go into that particular customer's account, and we would use this as a basis for sending them a bill. So if they will receive a bill from us that will tell us what their purchases were and how much they owe us. At the end of the month, before we do our financial statement, we need to think about what's going to happen over here, and that is we need to think about bad debt expense, which is our estimate of the credit sales for the time period that will not be paid. Now, this is an expense. It is also minus stockholders' equity or reducing stockholders' equity. Again, it reduces stockholders' equity because it reduces retained earnings. So expenses are debits, and this shows up as a debit. We need to talk about the credit. The credit is not to accounts receivable directly, but to an allowance account, allowance for doubtful accounts. Now, sometimes it's called allowance for uncollectible accounts. It's just a different terminology. This allowance account is a way for us to reduce our accounts receivable without reducing a specific individual's account receivable. And so we set up this contra account, and notice it is being credited here, and here you see it's an increase to a contra asset. Well, the asset we're talking about is account receivable, so it's an increase to a contra asset, which means it reduces accounts receivable. This journal entry needs to be done whenever we have credit sales before our financial statements are prepared. So we don't do this journal entry as we are having the sales. We wait till the end of the month and we estimate our bad debts by doing this journal entry. So before we do our financials, if we're doing our financial statement for the month, and we would be January 31st for our month end, we would do this journal entry. This amount then shows up on our income statement, and we talked about matching because we have the revenue, our credit sales, showing up in revenue, but we also have a reduction in that revenue, if you want to think of it that way, for the bad debt expense, or the amounts that we do not expect to collect. Also, when you look over here on the balance sheet, this allowance account is shown as a contra account, so whenever accounts receivable is shown, you're going to show the allowance account as an offset. This would be subtracted from accounts receivable to get what we call a net accounts receivable. So it helps us not to overstate our accounts receivable. If we just prepared our balance sheet based on these transactions, we would not be doing it properly because we would be overestimating our receivables, because we wouldn't be taking into account those that we do not expect to collect because the customers aren't going to be paying us. Now, so on January 31st, you're going to record this, and this is sometimes called an adjusting journal entry because it needs to be done before we do our financial statements, when we know the actual amounts that are not collectible. Now, when will we know this? This is when the credit department says we've tried to collect and we can't collect. When we actually know we're not going to be able to collect, then is when we credit an individual account receivable to remove it. So the credit department will come back to us and say, this individual is not going to pay us. We have tried. We have sent statement after statement after statement to this customer, and the customer is not paying us. Then we remove the balance, and this will in effect stop the statements going out to the customer, and we will record it as a debit to allowance for doubtful accounts. You're going to say, well, why don't we debit expense? Because we have already debited expense for that customer. We debited that expense for that customer when we did our January 31st adjusting journal entry, and we recorded as bad debt expense. If we had done it as bad debt expense here, we would have been doubling the amount of bad debt expense that we would be recording, and we don't need to do that. We only need to record a certain amount set aside as an estimate of our bad debt expense on January 31st. When we then know the actual amounts that are uncollectible, then we take it to this allowance for doubtful accounts. So this is crediting the allowance, and this is our estimation journal entry, adjusting journal entry at the end of the month or before the financial statements are prepared. And this is debiting the allowance for doubtful accounts when we actually know that a customer is not going to pay us. So the allowance for doubtful accounts is a contra accounts receivable account. And you really don't stop trying to collect on accounts just because the customer hasn't paid, by the way. We still try to collect. It's just that our credit department tells us that it's unlikely that the customer will pay. It is the opposite of a normal balance of accounts receivable in the allowance account, so it has a normal credit balance, and it gets credited at the end of the month. So you're creating this account at the end of the month as an adjusting journal entry. It goes away as specific accounts are identified, and it is debited then when you remove the balances from the accounts as you identify customers that haven't paid. So there's two steps to it. You make this estimation of bad debt expense related to your prior month's, this month's credit sales, and then there's a delay at which point you determine that certain amounts of those sales will be uncollectible. Here we have VFC estimating $900 in bad debt at the end of the accounting period. So before preparing their financial statements, they are going to estimate how much bad debt they'll have. They record it as bad debt expense, and they're going to credit it, and they're going to put it in this allowance for doubtful accounts. This is going to increase our allowance for doubtful accounts, which is a contra asset. It is going to, in effect, reduce accounts receivable because you're always going to show the contra account with accounts receivable. So our net accounts receivable is going to go down as a result of this journal entry. And then later on, we determine that Fast Fashions is not going to pay us. They're not going to pay on their account. When they no longer are going to pay on account, we don't make this determination, the credit department does. We will remove the balance in accounts receivable, and we will take it to the allowance for doubtful accounts. Now when you analyze this, you see all of it is within the asset side, and these are both accounts receivable accounts. This is an account receivable. This is the contra to that account receivable. And so we are moving between these two accounts. Our net accounts receivable as a result of this journal entry doesn't change. Accounts receivable, the specific one in the name of Fast Fashions, is credited to be removed, and the allowance for doubtful accounts is debited. Again, why do we not debit bad debt expense? Because we've already done that. We've already debited bad debt expense when that credit sale was made to take into account our estimate of those accounts that will be uncollectible. So combining these two journal entries then, you can see we can think of this allowance account as a holding bucket, and we put in $900 and we take out $800. And some of you are going to say, well, wait a minute, we said we were going to have $900 and we had $800. But you have to also think about it this way. Even though this $800 is our actual write-off of an account receivable that we have identified, there could be another $100 which may come in at a different point in time. Our credit department may identify another $100 that needs to be written off later. So we have a holding bucket then, and when you go down and look at the T accounts, you see we started off with an estimate of bad debt for our previous sales, our sales prior to this month. And now we have another amount coming in for our sales for this month, and we also have $800 being taken out of this holding bucket as we specifically identify those accounts. And so this balance in the allowance for doubtful accounts goes up, goes down, but it has a normal credit balance. Our accounts receivable, our total accounts receivable, $199,200, a debit balance. This is the offset to it. So when we prepare our financial statements, we cannot just say we have accounts receivable. We also have to put in there our allowance for doubtful accounts to reflect the reduction, our estimate of how many of those accounts receivable will not be able to collect. Bad debt expense is a income statement item. Therefore, it does not have a beginning balance. It starts at 0 for the month, and we put into it our estimate for the month of those credit sales in that month that we expect to not collect. So this is recorded monthly. At the end of this month, then we would start again, and in February you would expect to see another amount here for another estimate related to our February sales.